this is a topic that hits fairly close to home because it's a topic that we often see a lot of retirees making mistakes on within their own retirement. And again, within each of your tax buckets, each of these tax buckets can be used effectively to increase your after-tax wealth. But again, using these tax bucket effectively isn't as straightforward as most people think. So we're going to be talking about non-qualified accounts here today, taxable accounts, brokerage accounts, joint accounts, and we're going to be covering 5 simple taxable account rules that you can use for tax efficient investing. Okay, so let's hit the ground running. And again, thinking about your different tax buckets, most people think about their 3 tax buckets. Okay, they have a taxable account. This would be like a checking or savings account even. But most of the time we're talking about, specifically in this presentation, a taxable account that you're using to invest. So a brokerage account, whether that's an individual TOD, whether that's a joint account, a community property account, non-qualified accounts, and such. And this can often be a leaky bucket, but it's only a leaky bucket if you don't know how to patch those leaks. So we're going to be talking through how to patch those links. Obviously, your other 2 buckets are a tax-deferred bucket, traditional IRAs, 401ks, and such, and then you have your tax-free bucket, Roth IRAs. So we're going to be focusing on that first bucket and how do we patch the holes within that bucket? How do we patch that leaky bucket? Okay. And so you'll often see charts when people talk about the benefits of contributing to a tax-deferred account versus contributing to a taxable account. You'll see charts that look a lot like this. And a lot of numbers are hidden in the background, but it almost always looks like contributing to a tax-deferred account is almost always best. And what I want to kind of lay the groundwork, lay the foundation for right off the bat is it depends for every person's situation. So it depends what's the tax rate you're at right now versus the tax rate you're going to see in retirement. It depends on how you're managing each of these buckets. It depends on how they're running the numbers for this as well. Are they taking out taxes out of that tax-deferred investment, or are they just simply looking at that tax-deferred investment as the whole bucket, not looking at after-tax wealth? And so what I want to make sure I get across at the beginning of this presentation is your taxable account, for some individuals, it will actually make more sense to contribute to your taxable account. For other individuals, it'll make more sense to contribute to your tax deferred. But as far as using your taxable account, okay, how much value you gain out of that taxable account will depend on patching those leaky holes within a bucket. And the reason it's often thought about as a leaky bucket is because with certain investments that you have within that taxable account, such as, let's say, fixed income, okay, the interest from that fixed income is taxable to you each and every year at your ordinary income tax rates. Okay, so that's money where, again, you're paying out taxes rather than deferring taxes, rather than paying taxes up front and never having to pay taxes again. You're having to pay taxes each and every year. And this is basically where this chart comes from with people thinking that the taxable account is a worse account. But if we think about it, okay, when we're contributing to any given tax bucket, there's the potential to pay taxes at 3 different times. Okay, you can pay taxes right off the bat, okay, for the contribution to that given account. Obviously, with a taxable account, you need to pay taxes first in order to contribute to that account. Okay, for a tax-deferred account, you get a tax deduction. Okay, so it lowers your taxable income in that given year. For a Roth, you pay taxes and then it's never taxed again. Okay, the second part where you could be taxed is on the growth. So again, a Roth IRA and a tax-deferred account essentially defer growth. You don't have to pay taxes on the growth in those given years, regardless of how many transactions you make in that given account. Okay, within a taxable account, at each transaction point, you may have to pay taxes. Okay, and then there's taxes on the potential withdrawal. Again, with a tax-deferred account, that's where you owe those taxes. Okay, with a Roth IRA, you pay taxes on the front end. You're never going to pay taxes again. With the taxable account, again, if you're selling an investment, there may be taxes owed there. But again, we know that paying taxes isn't necessarily the bad thing. Okay, it's how much you pay in taxes. So really where the value with a taxable account comes at is understanding the difference between long-term capital gains and short-term capital gains. So if you've held an investment in a taxable account for more than a year, it is a long-term capital gain. If you've held it for less than a year, it's a short-term capital gain. And so again, as far as using a taxable account tax efficiently in your retirement, where the real value comes from, it's essentially trying to transfer whether it's growth taxes that you owe or taxes on the withdrawal, trying to make sure that they're looks like I don't have my drawing tool here. Trying to make sure they are long-term capital gains, because almost at every different income point, you will notice that long-term capital gains is at a cheaper rate than ordinary income rates. And so again, this is where a taxable account can all of a sudden start to be a little bit more valuable in certain circumstances versus a tax-deferred account pulling from an IRA. Because as you pull from an IRA, again, it's always going to be under ordinary income rates. Taxed at 10%, 12%, 22%, 24%. At these various points, okay, you will have a cheaper long-term capital gain rate. Okay, so for instance, let's say we're at an income base of $100,000 of taxable income. Okay, if we take out any more income, we're going to be in this 22% bracket here if we're married filing jointly. Okay, if we're a single filer, we're going to be in the 24% bracket. Okay, versus in long-term capital gains for a unmarried, for a single filer as well as a married filer, we're at the 15% rate. So again, when we're thinking about paying less in taxes, we look at the marginal tax rates. We can pay lower at any given point pulling from a taxable account versus a tax deferred account. That's where we start to see some, again, tax efficiency happen. So again, my goal so far is basically just to lay the groundwork that your taxable account can actually be very valuable if you fix the leaky bucket. From here on out, we're going to be talking about how to fix that leaky bucket. Okay. And so when we think about the 5 rules that we'll follow, okay, there's a core principle of tax planning that we always want to remember, whether we're thinking about any area of our retirement tax situation. We want to take income and create a taxable event when we choose, not when we're forced. Okay, so that's why forced income, whether it's in the form of an RMD, whether it's in the form of a pension, whether it's in the form of rental income, whether it's in the form of some of the issues that we'll talk about within this taxable account presentation, we don't want to be forced to have income. Ideally, we always want to be able to choose which given tax bucket it makes sense to pull from at any given time in any given year, because we can choose to pull from and create a situation where we're paying far less in taxes throughout our retirement versus what we would have to pay if we were forced to take, again, income at given points. So again, all of these 5 rules central around this point right here, patching that leaky bucket. The reason it's a leaky bucket is because sometimes you're forced to pay income or forced to pay taxes from that given account if not managed properly. And so this is an issue we often see within our practice. Someone has a taxable account of various sizes. I'm just using a $280,000 taxable account right here. Some people have far larger account. Some people have less of an account. But again, basically, here's what we see on an annual basis. If this is a leaky bucket, which it often is for a lot of retirees, there's long-term capital gains, there's short-term capital gains, there's income coming out of this taxable account. And so this is taxable income that you have in that given year. And when we're talking about retirement tax planning, we're talking about certain hurdles that act as a cliff. Okay, what do I mean by a cliff? For instance, IRMA, Medicare increases. When you have when you go over the IRMA limits, IRMA thresholds, it doesn't matter if you go over by 10 cents or $10,000. You now owe that penalty, that IRMA penalty. Same thing with an ACA subsidy. Okay, when we're back in the ACA subsidy cliff, when you start to go over that cliff, again, you lose that subsidy in a big way. That's why they call it a cliff. And there's there's all of these different hurdles in retirement that aren't marginally increasing hurdles. They are cliffs. Okay. And so when we have unexpected taxes coming from, or taxable events coming from our taxable account, it can really throw tax planning in retirement into a tough situation. For instance, here we see this person has about, $14,000 in income coming from their taxable account. Now, this income is taxed at various rates. Obviously, short-term capital gains is taxed at that ordinary income rate. Long-term capital gains taxed at, long-term capital gains rate. Income, again, taxed at short-term capital gain rates. And so in this given year, $14,000 worth of income might be eliminating $14,000 that they could perform as a Roth conversion. Now, is that a huge deal in the grand scheme of things? Probably not so much, but stacking these on year after year and being able to convert less because you have this leaky bucket starts to create a tax situation where we start to become very tax inefficient. And then again, those hurdles we also need to be thinking about that we can be pushed up into. And again, If we have the choice and we took those long-term capital gains by choice, that's another point. Okay, but if we were forced to take it from having, again, the wrong investments in this account, that is what we are trying to avoid. I often see this as a tax nuisance for a lot of retirees because they set their situation up properly and then they get a surprise at the end of the year for whatever reason. And now it throws their tax situation into a little bit of an issue, okay? And so let's start hitting on these 5 simple rules. The first one is don't hold mutual funds in a taxable account. Now, I'm certainly of the opinion that I don't believe we should really be holding mutual funds throughout our retirement, but if you're going to hold mutual funds, hold them in a tax protected account, a tax deferred or a tax free account like a Roth IRA. The reason you don't want to hold mutual funds in your taxable account is because you are essentially giving over ownership, tax ownership of your account to that mutual fund manager. Now, a mutual fund manager is obviously managing, in a lot of cases, hundreds of millions, billions of dollars for investors. I can promise they are not thinking about your given tax situation. Okay. And again, the problem with mutual funds versus something like an ETF alternative, a mutual fund is a pass-through entity. So given a mutual fund, when there is buying and selling within a mutual fund, it passes on to the investors. So what you'll often notice with a mutual fund is compared to an ETF alternative, is you have a lot more in long-term capital gains, short-term capital gains. Obviously, various dividends through each of those will be passed through to the investor, but essentially everything is being passed through to the investor. Any changes that mutual fund manager is making, you are now having a taxable event because of that. And so we'll go through some examples that we can see that mutual funds are far more tax inefficient. This shouldn't be a surprise to anybody. There's a lot of literature written about this. ETFs work a little bit differently. There is essentially a market maker that is the in-between for essentially ETFs trading in and out of given investments, which means it's not being passed through to the investor, making it much more tax efficient. Let me show you some examples. I think, yeah, perfect. I have coming up here that will show exactly what I mean. And I'm trying to compare apples to apples as much as possible here. Okay, so given a large cap growth mutual fund, I'm trying to compare that to a large cap growth ETF. Apples to apples as much as I can. So on the screen right now, we have American Funds Growth Fund of America. And we have their distribution history. I've taken this from Morningstar. Everyone can look this up if they go to the performance tab in a given fund on Morningstar. They can click on the distributions within the performance tab, and you'll basically be able to see distributions through time. Okay, and it'll show income, short-term capital gain, long-term capital gain, and whatnot. And so basically what you want to do is you want to compare the overall distribution of the most recent year or a previous year compared to the NAV, the share price. And so what we'll see in 2020, American Growth Fund of America, this is a large cap growth oriented mutual fund. Okay. It had $2.90 of a distribution to investors. Now, $2.90 doesn't mean a whole ton of a lot because we have to compare it to that mutual fund share price. And when we compare to the mutual fund share price of ending the year at 67.15, okay, what we're going to see is this American Growth Fund distributed 4.3% of its fund in this given year as a long-term capital gain. So this was forced income. So if you had $100,000 within this fund in 2020, okay, you would have had $4,300 of taxable income, long-term capital gains at least, but nonetheless of taxable income that would have been forced upon you that you had absolutely no choice over. And so are there better alternatives? Let's compare to Vanguard Growth ETF. Again, this is a large cap growth ETF, okay? And now with ETFs, there are distributions on a quarterly basis. So you'll notice there are a few more additions that you have to add up to figure out the total distribution for that given year. But what I've done this work for you. And so for 2020, there's $1.68 of distributed income. Again, that doesn't mean a whole ton of a lot until we compare that to the share price of the ETF. Share price ending the year at $251.25. We'll notice there was far less in the way of forced income. So what is generally the forced income that we're looking at for ETFs? It's typically dividends that are being passed on, okay? And so again, whether that's a qualified dividend or not, again, depends on the length that you've held of that given investment, okay? And so What we'll notice, again, far less forced income. So when we're thinking about plugging this leaky bucket, we don't perfectly plug the leaky bucket, but we do a pretty good job. Okay, far less, a fraction of the forced income in this given year. And just to round out and compare performance-wise, not that I'm recommending either of these funds, but again, comparing performance-wise, you'll notice that the Vanguard ETF is not only more tax efficient, it's also more cost effective, which leads to outperformance over time, over this given period at least. Okay, and so again, more tax efficient, you're still getting that same large cap growth exposure. You'll notice when we look at all of the ups and downs of each of these investments, they are very correlated, again, being both in that large cap growth sub asset class, and yet one was significantly more tax efficient. So when you look at after tax performance, again, the ETF will oftentimes be significantly better. Okay, let's compare again. This happens across mutual funds. I'm not just cherry picking certain mutual funds. Okay, I'm only showing a few examples here, but obviously we don't have hours to go through mutual fund by mutual fund and compare to an ETF. So JP Morgan mid-cap growth. So obviously this is a mid-cap growth fund. And once again, we're going to see some very significant distributions. We had 66 cents. That was a short-term gain. Okay, would you have taken a short-term gain? Well, probably not, but you don't have control over your tax situation. That mutual fund manager does. So 66 cents of a short-term capital gain, $4.79 of a long-term capital gain. Add those together, we get $5.54. Comparing that to the share price of $51.25, we're looking at 13.2% of forced income in this given year. $100,000 and you now have $13,200 of forced income that is partially taxed at ordinary income rates, partially taxed at long-term capital gain rates. Versus, let's take an ETF counterpart. Okay, apples to apples. We got the mid-cap growth ETF here. And again, looking at totaling these distributions, we're looking at 39 cents on a share price of $100.15. Okay, and again, this is primarily in the form of dividends. And we had 0.39% of forced income. So comparing that to 13.2%, we can see one is far more tax efficient. And then again, comparing performance, obviously they track fairly closely. Fee-wise, again, the ETF tends to outperform over time. This isn't always necessarily the case. There are certainly mutual funds that outperform their ETF counterpart, but oftentimes you'll see that it's the case that an ETF being more tax efficient, more cost effective, outperforms. Now, the tax efficiency doesn't help you inside something like a tax deferred account, but certainly does in a taxable account. Okay. And so Morningstar will actually rank mutual funds on a tax cost ratio, basically the percent deduction or the subtraction from growth for being tax inefficient, if you will. And what you'll notice again across the average mutual fund compared to ETFs across the board, ETFs are much more tax efficient. Tax managed mutual funds even that are marketed as being more tax efficient still oftentimes underperform their counterpart ETF. So this is very well known in literature. Morningstar has a lot on this front on the tax efficiency of most investments. And so making sure you put tax efficient investments in a given taxable account will plug a lot of that leaky bucket. Okay. Rule number two, don't hold bonds or fixed income investments within your taxable account. Again, we're not big fans of owning bonds and fixed income investments right now, regardless. We have a lot of videos on the reasons why. Low interest rate is a big reason why, and also thinking about where interest rates are going. But let's say you're going to hold bonds. Okay, generally, you don't want to hold them in a taxable account. Why is that? Well, again, how does a bond work? Okay, we have a quick example on the screen right here. $10,000 invested in a 5% fixed rate bond. Okay, you're basically earning interest each and every year. Okay, well, that interest, one, is forced income. It's a taxable event every time you receive that interest. And then two, it's taxed at ordinary income rates. Okay, so you don't get to have that long-term capital gain ability to, again, use those preferred rates. It's all at short-term capital gains, otherwise known as ordinary income rates. So again, after tax wealth wise, you are earning far less than 5% when you're constantly paying out taxes each and every year from that given taxable account. And again, fixed income equals forced income. Now, if you're going to hold bonds, hold them in a tax protected account. We have videos on that making sense anyway. Because again, if you're holding bonds, which are a lower growth vehicle, inside of your tax deferred account, for one, you're not being taxed on that interest each and every year. And then number two, you're also in a way minimizing RMDs through growth, something called asset location investing, putting the right assets in the right locations. And so again, as we've gone through history and looking at interest rates, luckily interest rates are low enough where bonds are as tax efficient as they'll ever be. Now, this isn't necessarily good news because the only reason they're tax efficient is because they're yielding very little. So back in this range when they were yielding, let's say 10%, well, obviously that 10% now as ordinary income rates was a lot more of a leaky bucket. Now that they're hovering around 1 and 2%, there's far less income that becomes taxable. But once again, that's not necessarily a good thing. It's partially because we're in this significantly low interest rate environment. And so again, why does this matter? Let's say we have a couple investing $10,000 in a bond versus in a stock. They're in the marginal 22% rate. And this is in a taxable account. Okay, let's say we've had the same growth. Obviously, we expect to have more growth from stocks. So let's just imagine these are different time periods. But let's imagine they've held the stock for more than a year. They've been holding the bond, obviously, for a lot more than a year as well. Well, the cost basis of the stock, they put $10,000 into this given stock, and now the stock has grown to $25,000. So they have $15,000 of unrealized gains. Let's imagine they realize those gains for income in a given year. Well, again, in the 22% marginal bracket, you're at a 15% long-term capital gain rate. Versus, as they were holding this bond, each and every year they receive that interest. And again, they've still grown their investment theoretically to $25,000, but they've had to pay taxes on that each and every year. Now, I haven't taken taxes out of this, but we can just see from a tax rate scenario, paying 15% is a lot more beneficial than paying 22%. You can hold the bonds if you want to, but hold them in more of a tax protected account. Okay. And again, we can see this when we open up bond funds specifically. So not just holding bonds individually, but holding bond funds. We can see essentially what we're looking at on a regular basis. Again, with a bond fund in general, you don't have control over taking long-term, short-term capital gains. That is on the mutual fund manager that trades in and out of those given funds. But nonetheless, what we can see here is moving through time, annual distributions, income being taxed at ordinary income rates. Okay. What about muni bonds though? Muni bonds, they're federally tax exempt. Well, in a way, yes. It's important to know that you add muni bond interest back into a lot of different targets. So muni bond interest, for instance, is counted against you for IRMA. So if you have muni bond interest and thinking that's left out of IRMA, it's not. So you want to make sure that you calculate back in that muni bond interest for IRMA targets. Social Security taxability. The more you have coming in from muni bond interest for Social Security, I should back up for a second. The more you have coming in for muni bond interest, the more of your Social Security benefit that will be taxed. Again, it's added back in for other targets. So people that say muni bond interest is completely federally tax exempt, that's not the case. Okay. Number 3, don't hold high dividend stocks. Okay. Posing a question to you all. Would you agree to blindly sell a portion of your stock position in your taxable account each and every year, regardless of if you need the money in that given year? Okay. Would you agree to just blindly sell portions of your stock position? Most of us would say, well, no, if we'd only sell if we needed it or we wanted to rebalance and change up our investments. Well, essentially what's happening with a dividend is that's exactly what's happening. Okay, that dividend is taxable in a given year. Now, again, it may be a qualified dividend taxed at preferred rates, but nonetheless, it is still taxable income that can push you higher into brackets or hurdles that you don't necessarily want to be pushed into. And so again, we may want to sell positions in a given year, but we don't want to be forced. And essentially what a dividend is that it's forced income once again. So let's say we have a starting investment, $50,000, 500 shares, $100 stock. Again, basically a dividend is a share of profits. Okay, so if we're valuing a company, okay, and we're valuing off the cash reserves they have, off the profits they are making, all of those things included, and they now pay out a bunch of their profits to, regardless of whoever it goes to, that certifiably lowers the value of the company. So a dividend is again, a payment of profits. And so there's two things we have to be thinking about. Obviously, we have to be thinking about the value of the stock and then how it's actually trading in the market. Now, the value of the stock and how it's traded in the market can often drift. If we think about valuing a stock, a dividend decreases the value. So let's say a 2% dividend decreases that value of a stock. Now, you can certainly invest right back into that stock, purchase more shares, and you still have that overall $50,000 investment, but you had that taxable gain, that taxable event from that dividend. And so again, we don't necessarily want to sell dividends or have dividends in given years because that is forced. We're being forced to take that income out. Ideally, we want to, again, take a taxable event when we choose to, not when we're forced to. A dividend is a taxable event. So a 2% dividend isn't really any different than selling 2% of your stock holding. Okay, we have a dividend investing demystified presentation on this exact topic where we talk through, citing people like Warren Buffett talking through this exact same idea. Okay, that's why Berkshire Hathaway doesn't have a dividend, because they don't want their shareholders to be forced to take taxable income in a given year. They want that shareholder to choose whether or not to take that taxable income. Okay, taxation of dividends has also changed through time. So dividends, again, qualified dividends are taxed at long-term capital gain rates. But again, that's changed through time. It hasn't always been that case. Previously, they've been taxed at individual income rates, making dividends that much less valuable as well. Okay, so keep that in mind. That could also change going forward in the future. I don't hear any discussions about that being changed, but it's been changed in the past. It could certainly be changed going forward into the future. And so ideally, when we're thinking about what to hold, okay, mutual funds are the worst thing to hold in a tax. Well, I should say bonds are worse than mutual funds, but again, bonds are an asset class. Mutual funds are a vehicle. As far as vehicles go, mutual funds are some of the most least tax efficient. Okay, ETFs are much more tax efficient, but even better than that is holding individual stock that has low or no dividends. Okay, and oftentimes we hear, okay, a dividend is a company that has a profit that is paying that out to investors. That's a very good thing. There might be some arguments from that standpoint, from a strategic business management standpoint, but there are certainly a lot of fantastic non-dividend stocks. For instance, I've already mentioned a few. Berkshire Hathaway is one. We have a list on here right now. I just basically took a stock screener and screened out all stocks that have dividends. And you can see there are a lot of big time names here. Okay, Alphabet, Google, okay, Amazon, Facebook, Berkshire Hathaway, Tesla, Alibaba, PayPal, Disney, Adobe, Netflix, Salesforce. There are some fantastic companies that don't pay a dividend. Now, I have zero issues with owning high dividend stocks, but hold them once again in a tax protected account. Think about your asset location here. Okay, hold no or low dividend stocks within your taxable account to plug that leaky bucket. Okay. And then 3B, if you will, a kind of an additional rule kind of on this dividend front is don't reinvest dividends. Why not? Again, in most assets or most retirement accounts, I'm fine with reinvesting dividends. It prevents you from having cash sitting on the sidelines when you might not be paying attention, and that's reinvested and at least growing. Okay, but why you don't want to reinvest dividends within your given taxable account is because you likely have set up an overall allocation, whether that's in stocks, whether that's with muni bonds, whether that's in a number of different asset classes. You've set an allocation. Ideally, typically, you want to rebalance back to that allocation. Well, when we're thinking about reinvesting dividends, we're essentially reinvesting dividends in some of, oftentimes, some things that are performing very well. And so we're forced to sell. That's what a dividend is in a sense, or it's an equivalent event tax-wise. And now we're basically reinvesting that back in when we should be using that to rebalance. Okay, so you don't want to reinvest dividends because, again, if we look at 2009 to 2021, let's say we started out in our taxable account with a 60-40 into SPY, which is an S&P 500 ETF, and then MUB, which is a muni bond ETF. Okay, and we look over time, this 60-40 allocation, this allocation drifts through this 10-year, little over 10-year period to 82%, 17%. Now, ideally, this person probably wants to be rebalancing back to that initial allocation. That's why they set up that initial allocation. And so if they're reinvesting dividends, they're further increasing the spread here, where they could be taking those dividends and making a slight improvement from a rebalancing standpoint. They've already taken the forced income. Let's make the right move and rebalance off that dividend if you're going to have a dividend. Okay, rather than reinvesting and now having to sell at another time, potentially realizing short-term capital gains if you, depending on what shares you sell first and whatnot. Okay. Number 4, don't hold multi-asset funds. So what do I mean by multi-asset funds? Target dates are a perfect example of this. A target date is a fund where it has a date set out in the future, let's say something like 2035. And the idea being that if you're retiring at that point in time, you want to own the target date for that given year. And basically what they're going to do with this target date fund is they're going to start you out as you're younger in more aggressive allocations, stocks, and then through time, they're going to take you on a glide path that moves you more into bonds. And so this can create a bit of a tough situation for, again, fixing taxable account issues. Most of us, and hopefully this presentation helps a lot of us, develop a better tax efficient strategy for our taxable account. But in a lot of cases, there's going to be tax issues that you've already, again, through not knowing better rules, there are going to be some tax issues that we want to try to rebalance out of. Well, if you're holding a multi-asset fund, it's very easy to, let me step back a second. If you're holding separate funds, let's say you're holding a stock mutual fund and you're holding a bond mutual fund. So you're breaking some of those taxable account rules. It's typically very easy to trade out of that bond fund with little to no taxable event. The reason being is because you've been paying taxes each and every year. And so your cost basis has been rising through that time period. The only capital gain you might own is if that if that bond fund has essentially drifted higher or lower, appreciated or depreciated. Okay. And so it's very easy to do to trade out of and fix half of those taxable account issues. Again, a stock fund might still have a large unrealized gain, and we need to strategically decide when to take that gain and when not to. Well, in a multi-asset fund, you don't necessarily have that choice because that bond is included inside of that multi-asset fund. And so your cost basis is a mix of rising higher because of the bonds and the interest each and every year, and then also having the larger unrealized gains from the stock performance. And so it's very difficult to deal with a multi-asset fund on an ongoing basis. So never hold them from the start. Okay, the other thing to note too is you'll often see that target dates or multi-asset funds are more expensive than holding those individual counterparts. The other thing that we also don't like about target date funds is they are allocating for you. So whether your income need changes or not, they're continuing the closer you get to retirement or even after retirement, continuing to allocate more to bonds. Well, you might not want to allocate to bonds. Well, it's very difficult to fix and trade out of those because you're trading out of the entire position. Okay. And so again, when we're looking at inside a multi-asset fund, let's say we're breaking out. Now, both of these will be combined together. This would be a $50,000 position. And let's say it's 60% stock, 40% bond. So when we're originally investing in this multi-asset fund, $36,000 was going to stock, $24,000 was going to bond. And the stock has an unrealized gain, let's say of $30,000. Again, if we're just looking at that position, this is all happening inside this multi-asset fund. The bonds, you've been paying taxes on this each and every year, so you've realized interest. And so your cost basis is really $34,000 now because that $10,000 has been taxable each and every year. Well, now how do we trade out of this multi-asset fund in a strategic way? To do so, we have to unfortunately realize this gain where we might not want to realize this gain. So this is part of the issue of holding these multi-asset funds. They're very difficult to essentially try to leg out of, if you will. Number 5, right? Yeah, 5. Don't actively or short-term trade. Okay, when we think about, and again, this you could argue this might not be the most important metric depending on your goals, because safety could be risk could be just as important of a metric. But bear with me as I as I kind of have some hyperbole here in some of our presentations. What is the most important metric in investing? It's not growth. Okay, most people think growth. No, it's after-tax growth. And this is really the case in any retirement decision that we make. Again, in Social Security, I often talk about that we need to be looking at everything through a tax lens. And so we might be getting a $2,000, let's say, Social Security benefit, but if we're ultimately only keeping a fraction of that, let's say $1,500 of that because of taxes, well, we really have a $1,500 Social Security benefit. We don't have a $2,000 Social Security benefit. So at every point in our retirement, we need to be looking at after-tax numbers, not, again, nominal numbers or pre-tax numbers. So after-tax growth matters. Well, why does this matter with short-term or active trading? Again, I don't necessarily have an issue with you actively trading, but do it in a tax-protected account. The reason being is because, again, between short-term and long-term capital gains, what determines whether it's a short-term or long-term is how long you've held that investment. Well, by definition, if you're actively short-term trading, you're going to have a lot more short-term capital gains. It's going to be very, very tax inefficient. Short-term capital gains, you're back into the ordinary income rates. Long-term capital gains, you're at preferred rates. Again, we already went over this, but the last thing that you want is to continually have taxes at higher rates. Now, with a taxable account, we can affect this in a big way. Holding investments for a long term. We want to be more of long-term investors. I would make a case we should always want to be long-term investors. Okay, but again, certain people think there's value out of actively short-term trading. Do that in tax-protected accounts. Again, at every various point, it's going to make more sense to take that long-term capital gain versus that short-term capital gain. But when you're actively trading, every time you trade out of an investment, you are realizing a gain or realizing a loss. Okay. At the end of the year, those will all offset each other. And if you've done well actively short-term trading, you're going to have a ton of short-term capital gains back at ordinary income rates, pushing you into higher brackets. Okay. And so just period, beating the market is hard. Now, I'm not going to go too much on a soapbox here, but there's an awesome report that comes out semi-annually called the SPIVA reports. It's put out by S&P Global. And basically what they do is they compare all equity funds, bond funds, international equity funds to their given benchmarks. And so, for instance, they'll compare large cap equity funds to the S&P 500. And you can see going down the way, they compare a lot to the given index, and being an S&P report, they compare to that S&P given index. And so from 1 to 3 year, you'll notice there's a lot of difference. Sometimes the equity funds outperform in a given year, depending on what kind of year that was. What I care more about, again, is long-term investing. Let's look at the 10 to 20 year periods. And what you'll notice, again, the higher the percentages, this means that most equity funds are underperforming their given benchmark. And so you've got essentially mutual fund managers or fund managers in general that are huge shops, okay, spending millions, if not sometimes billions, on research, employing an entire staff to try to beat the market. And yet, on a continual basis, 10 to 20 year period, we notice that 75 to 95% of funds underperform their given benchmark. So it's very difficult to beat the market, period. Certainly much harder when you're now taking a higher tax rate within your taxable account because you're forcing yourself into that short-term capital gains rate. Okay, and so let's look at a very kind of cherry-picked example here. Let's say in an index ETF, just owning the index for the long term, you're going to earn 8% per year. Okay, just hypothetically here. Now, after 15% long-term capital gain, okay, your after-tax return is 6.8%. Now, let's compare that to an incredible manager, okay, an incredible mutual fund or fund of some sort. And typically, obviously, that they're incredible, they're going to have a larger cost. Okay, if you have a track record of doing very well, you can charge quite a bit in order to continue to do well. So let's say on a gross return basis, this is outperforming that given index by 2%. Now, this would be a fantastic, consistent outperformance if this happened over the long term. Very difficult to do. Okay, 2% doesn't seem like much, but Again, if we start to lay out numbers for 2% excess return, one, you'll find very few investors, very few managers that have ever done that. A lot more that have failed to do that and thus had their investors have a much lower rate of return. But let's just say this is a hypothetical example. Incredible manager, 10% per year return. After their 1.2% fee, they take off the top. And then let's say this person is at a 24% marginal tax bracket. So they have 24% in short-term capital gains. Well, all of a sudden, even though they earn 2% more, because they're paying more in taxes, because they're paying more in fees for active management, their after-tax return is 6.7%. Now, again, these numbers are fairly skewed. I used a very high target of 2% more per year than the index fund. I added in a fee as well. The big difference, though, as well, is this spread will always drag down performance. You need to be getting that much better of performance because you'll have a higher tax rate coming out of that. And again, we care about after-tax growth, especially in a taxable account. Okay, and avoiding tax drag. Morningstar cites on average over a 94-year period in 2019, investors gave up 1 to 2% of their points to their annual returns to taxes. And so let's think about this again as we talk through again, safe withdrawal rates in retirement. Let's bring this back to retirement. Okay, studies that have been done in the past, like the 4% rule, are based off a 60-40 portfolio, based off a index of the 60-40 portfolio. Well, now if we think about taking taxes out and that lowering by 1 to 2% based on this study, does the 4% rule still stand up? Now, there's been a lot of discussion with the 4% rule just in general, paring that back as interest rates have gone far lower, saying that more acceptable withdrawal rates are more in that 3% range. But nonetheless, we have to be thinking about this. And most of the time when people are running things in a spreadsheet, they're not necessarily thinking about the tax drag, okay, and how that eats into performance, how that eats into the withdrawal rate that you can eventually take. And again, some of these tax drags, 1%, 2%, again, because of compound returns, whether you're paying out 1% extra because of a tax drag, whether you're paying out 1% extra because of an advisor that you're paying, whether you're paying out more in mutual fund fees, regardless of what's dragging down your performance, whether it's inflation, okay, compounded deductions over time really start to add up. This is just a quick chart. $500,000 initial investment earning 7.5% per year grows to $1,031,000. 1% lower return due to tax drag, $939,000. 1% lower than that, $854,000, just through a 10-year period. So we can start to see how these tax drags add up over time. So what can you do about it? Well, again, basically fixing these taxable account rules, following these. Don't own, again, going through these, don't own mutual funds in a taxable account. Don't own bonds and fixed income in a taxable account. Own them in a tax-protected account. Don't hold high-dividend stocks in a taxable account and don't reinvest dividends. Don't hold multi-asset funds, okay? And then don't do short-term trading in a taxable account. Do all of these things in a tax-protected account. Okay, we can argue still on, certain investments might be better at that given point, but just from a tax perspective, you don't want to own these in a taxable account. They will drag down your performance over time. Instead, next best alternative would be ETFs. Much more tax efficient. Study after study shows this. After that, holding individual stock, direct indexing, making sure you're not holding high dividend stocks, but rather low or no dividend stocks are going to be much better ways forward. You generally want to hold growth investments that don't have dividends. So REITs, for instance, aren't a great solution in your taxable accounts because once again, they have fairly large dividends from REITs. Okay, primarily want to have stock allocation in that taxable account. Take advantage of those long-term capital gains. That's the whole reason why Warren Buffett says he pays a lower rate than his secretary. He must pay his secretary quite a bit, but he is realizing rates at, again, those low rates, those low long-term capital gain rates, because the majority of his income is from selling, let's say, Berkshire Hathaway stock. Okay, so once again, you want to fix and patch the leaky bucket in this taxable account. These 5 simple rules will help you do so. If we have any questions, I'll try to answer those in the comments after I'm done with this presentation. Always remember though that you don't need more money, you need a better plan. If you like this video and you're watching on YouTube, make sure you hit the like button down below. It helps other retirees find this video and benefit from this video. Also, if you haven't yet, hit the subscribe button as well. We release videos weekly on this channel on how to improve your retirement, propel your retirement forward. Based off this model right here, you don't need more money, you need a better plan. Thanks for watching. If you have any comments below, any questions, let me know below and I'll make sure I answer them. Appreciate you guys watching. As with every week, we'll be back next week with another Wealth Wednesday. Look forward to seeing you all next week. Bye.